It will eventually generate some.
Okay, let's have a look at this. Hang on, let me tick off some names quickly first. Who have we got? Anne? Esther? Niharika? Rachel's not here. Korchika? Manuela? Sharmila? Roshani? Craig? Dora? Cindy? James? Rupa? Arlene? Muyan? Murray? Iris? Sam? Asha? Yemin? Nevada? Conchira? Anyone I've missed? Okay, let's get on with it. So today we've got cash flows from last week. So it starts to get a little bit harder. Those of you who went to the lecture will know that it gets a bit harder, and then gets a little bit harder again, and then a little bit harder again. Right. So you've just got to keep on practicing. And if you can't, you're not sure what you're doing and you can't get it, you need to make sure you get it, because the final exam is worth 25 marks, so 25 out of 50, which is 50% of your final exam, which is 25% of your overall grade. All right, so I have put a study pack up on Blackboard, but you don't have to rush to go looking at it straight away because you've got to finish your assignment first. All right, so I'll probably do up another, I haven't decided what I'll do yet, but if we need some more practice, I might do up another mock test or something, all right, for the last week. So I'll just, I'll work that out in the next couple of days. All right, so today, now you had question 6.2 online, right? The answer's there. Now, who's had a chance to do it? Has anyone had a chance to have a go? It's all right, so I didn't think too many people would have had a go, but I mean, I just thought you'd try, but I know, but it's just that time of year. Assignments are due. Everyone's just finished mid-semesters. You finished all your mid-semesters, haven't you now? All right, assignments due, all that kind of stuff. But so 6.2, we'll spend a bit of time going through that one, and then we've got a new question 6.5. So we'll just see how we go with the time and get through as much as we can. So with a cash flow, it's just a case of making sure that you just do everything step by step, and we'll go slow. Okay, so a little bit of theory first. What is the purpose of your statement of cash flow? So it's one of your core general purpose financial reports to give you a snapshot of the cash. So, and it divides it into operating, investing and financing activities. So you need to be making money from your core operating activities. So cash is not the same as profit, right? Essentially what your cash flow is, it's your bank account, isn't it? So all the money going in and all the money going out, and just divide it into operating, investing and financing. Right? It sounds simple, but you need to keep that idea in your mind, and then there is a process we go through to be able to extract that data from our accounts in a different way. Okay, so what is the purpose of your cash flow, and what and how can it be of benefit? So you'll have to read that for you, but essentially it looks at the financial structure. So looking at where your money's coming from, what are you spending on how are your core operating activities contributing to the rest of your business? Are you paying too much money in cash for employee expenses? How much money are you putting into plant and equipment? Are you looking to the future? So there's lots and lots of different things that your cash flow will show, but it also gives you the ability where you highlight if you're going to have problems, then how do you adapt and change into the future. Right, so there's quite a lot there, so I'll leave you to read that yourself. But more importantly, with a cash flow, being able to do a good cash flow, it does help you with your planning and controlling, particularly for budgeting. Right, making sure that you know exactly where your money's coming from, the timing of when that money's coming. Do you have enough? If you don't, how are you going to cope? Can you get a bank overdraft? Can you get a bank loan? On the other side, if you've got extra funds, what can you do with it? Can you invest it into the business? Is it better to put it into fixed term deposits, which at the moment is not a particularly good idea because fixed term deposits don't pay you any money. You're better off trying to find ways to use that money to generate money for you in other ways. So we'll have a look at some items just to get you into the swing of whether an item is operating or investing or financing. So that's the three key classifications with a cash flow, as you must divide them into operating, investing or financing. Operating is your core business activity, so it's accounts payable, accounts receivable, so paying for those. It's paying your wages, it's buying supplies and inventory. Whereas your investing activities are your cash inflows and outflows, mostly in relation to non-current assets like plant and equipment, land and buildings, those kinds of things. Your financing activities is essentially where do you get your money from to run your business? Have you issued shares? So have you had inflows from shares? Have you issued debentures? Have you had inflows from debentures? All right, and then the associated payments for those, so payments for your shares and interest on debentures and things like that. Okay, so your bank overdraft is essentially an operating activity, but you could classify it as financing depending on the nature of that overdraft. So we won't get into the nuts and bolts, but 9 times out of 10, a bank overdraft is an operating activity because you've got that overdraft because you need to meet short-term obligations, all right, rather than longer-term. Cash loans made to employees, those loans are usually loans over long periods of time. They're not usually short-term. It's not uncommon for some businesses that are big to give low-interest loans to employees. All right, so, interest rates at the moment are varied, but you might low or even no interest loans to employees. That's an investing activity. Proceeds from sale of investments is an investing activity. Notice it has investment in the name. So it's usually, if that is a dead giveaway, that it's an investing activity. Depreciation of plant. That's the other thing. If it doesn't hit your bank account, it is not cash, right? So that's the first thing you should always think of is, does this hit my bank account? No, it doesn't. Therefore, it's not cash. Income tax paid. All right, 9 times out of 10, income tax paid is an operating activity. All right. However, with some businesses, it might be deemed to be, components of it might be deemed to be financing or investing, depending on the nature of what it is. The rule of thumb for us is we treat it as an operating activity. Right, so the textbook treats income tax expenses as an operating activity, but there is scope within AASB 107 for you to treat it differently. All right, so sale of a motor vehicle is an investing activity. Okay, it's a non-current asset. Right, anything to do with non-current assets, investing activities. Issuing of ordinary shares in exchange for convertible notes. It's actually a non-cash flow item. If it's material, it requires a note disclosure. All right. So it's something which would need to be disclosed in your equity statement as well. Bad debts written off, right? It is a non-cash flow item, but those of you who attended the lecture today would know that you need to account for bad debts when you're looking at the movement within your accounts receivable and your allowance for doubtful debts when you're recreating accounts, when you're preparing a cash flow. Bad debts recovered, it's an operating activity. So remember, your bad debts are associated with accounts receivable. What did I do? Okay, bad debts are associated with accounts receivable. Accounts receivable is a normal operating activity. Revaluation increases for land. Does it hit your bank account? No, it doesn't. So it's a non-cash flow. Transfers from a general reserve to retained earnings. It's a non-cash flow. It doesn't hit your bank account. Dividends declared and paid. Well, certainly the dividends paid, all right, hit your cash flow. It is what is paid is a financing activity. All right. So where dividends are concerned, how do we know how much they paid if they don't tell us? We need to recreate our retained earnings account, all right, which is part of our equity. If we recreate that, remember your retained earnings includes the accumulation of your profits over a number of periods, and you can only pay dividends if you're making profit. Okay, so any cash payments and payments for dividends would be reflected, okay, in your retained earnings. Share buyback. It is you're buying them back, so it's an outflow. So there's money leaving, and that's a financing activity. Acquisition of a motor vehicle by way of a finance lease. Obviously, it's not a cash flow, but the lease payment is a financing activity because you've got a motor vehicle and you are financing. All right, so it's a way of, it's like a loan. All right, so you've got a financing activity there. There are ways where you can manipulate that and perhaps treat it as an investing activity, but it's not like you're not likely to be able to come up with the reasons to include it as part of those with your non-current assets because it's a leasing arrangement, it's a financing arrangement, it's like a bank loan. All right, so I don't think you could argue for it to be a part of your investing activities. Okay, so lots of limitations. I'll leave you to look at those later because we need to get on with this question 6.2 because I can't have you falling asleep on me in it. All right, because there's a lot to get through and we need to do 6.5 as well because the only way you get good with the cash flow is practice. So we've got 2 to practice today. We'll have 2 next week and we might have 1 or 2 more later. Right, so in the lecture today we went through a whole example. It took the whole lecture and that was question 6.9. So it might even be worth your while making sure you log on and you have a look at the lecture and going through that 6.9 as well. Because we added a little bit more to it again. All right, so 6.2, you've got that in front of you. So step 1, we have to work out what is our cash and cash equivalents. But before we do that, let's just peruse the data that we've got. So page 1, you can see we've got a balance sheet. We've got a statement of profit and loss. On page 2, we have a statement of changes in equity and we've got some additional information and what's required. So let's just read what's required first. Prepare a statement of cash flow for Brilliax Limited for the year ended 30th of June 2020 based on the direct method of presentation. Include a note disclosure to reconcile the net cash flows from operating with the profit for the year. Okay, we might leave that second part till next week. We might come back and have another look at that because that's what we did in the lecture today. All right, I'll just point out the little bits on it and you can have a look for homework and then next week we can maybe finish that off. All right, there are 2 types of cash flows you can prepare. You can either use the direct method or the indirect method. Right, the direct method is what you'll need to do in the exam, but you'll also need to prepare the note. All right, the direct method is basically what it looks like in the book where you have your heading, you've got operating, investing and financing activities. Your operating activities is your receipts from customers, then you've got your payments to suppliers and employees. With the indirect method, that section is replaced essentially with the note, all right, where you reconcile your operating activities to your profit in your profit and loss. All right, so that'll make more sense next week. So today we'll look at the direct method. So let's have a look at our balance sheet. Just let's peruse the items. So we've It's divided into assets, liabilities and equity. We've got the current year and we've got the previous year. So we've got 2019 and 2020. If we have a look at the items, there's been a movement there in your bank account, so it's higher than what it was last year. Right, so it's gone up. Your accounts receivable is a little bit less. Your inventories is a bit more. Your prepaid insurance has gone down $1,000. Your land, there's a movement there in your land. It's gone down. There's machinery that's gone down. But if we look at the net position there with your accumulated depreciation, there's an adjustment there. So we know that there's movements. So what we're going to do is recreate these accounts and see if there's a cash component in there as well. Looking at your accounts payable, just getting you to have a feel for the data that's there in front of you, right? Because this is what you're going to have to do in the exam. Right, your first bit is to peruse, then have a look at your P&L, look at what your profit is. So you've got 27,000 there in your profit. You've got sales, you've got some income. There's a gain on the sale of your machinery. Okay, that gain means that you must have received more money than what its carrying amount was. So if you take the cost minus your accumulated depreciation gives you the carrying amount. If you've made a gain, you've got extra money. All right, there's an extra cash component there. There's also a loss there on sale of land. What it means is that you had land worth X amount, but you've received a bit less, so there's a loss. All right, we'll have to recreate that account to work out the cash component. We've got interest expense, insurance, and other operating expenses as well. Okay, going back up to your balance sheet, we need to work out what are our cash and cash equivalents. So off the cuff, we don't have any bank overdraft. We've just got cash at bank, haven't we? So we're going to have to reconcile to that 23,000 cash at bank. All right, so last year it was 6,500, so that's going to appear in our cash flow statement as well at the bottom. But we're going to have to reconcile to make sure all our operating, investing and financing activities reconcile back to that 23,000. Okay, so what money have we had coming in? What cash have we had going out? How does it reconcile back to that 23,000? Okay, so step 2. So we've had a little bit of a look at step 2, looking at those movements already. But let's read the additional information now. We've got land with an original cost of $44,800 was sold for cash of $34,800. Right, so there's a $10,000 difference there. So if you go to your loss on sale of land, we've lost 10,000, but we've got a cash component there of 34,800. So that's an inflow. So circle that. Is that a operating, investing, or financing activity? Up to you. Anyone want to have a stab? You got a 1 in 3 chance of getting it right. Is it operating, investing, or financing when you've sold land? Yeah, it's investing. All right. Operating day to day, investing is non-current assets, financing mostly to do with shares and debentures and that. Okay, so right next to that, there you got put a big circle around that 34,800. We've got an investing inflow. Item B, machinery with a carrying amount of 25,000 had original cost of 33, was sold for cash of 34,000. All right, so a big circle around that 34. It's easy. We don't even have to recreate the account. We know the cash component, but if we didn't know the cash component, we could go to the P&L and we've got a gain on that sale of that machinery there of 9,000. We'd be able to work out based on the carrying amount, how much that they'd sold it for, all right, which is the 9,000 plus the 25. Okay, item C, lease income is earned from leasing part of the land holdings that are in excess of operating needs, all right, so maybe some of that lease income might be to do with investing, so we'll have a look at that. So now we've got to do our cash flow statement. First thing we need to do is work out our cash receipts from our customers. All right. So this one here, you've actually got the answer to this online. So on page 3 of your handout, there's a bit of blank space there. All right. So those of you who've got your computers, you can actually log on to the answer and you can have a look to see what your cash flow is going to look like. And you can start to reconcile back to that. So step 1, let's work out our cash receipts from customers. So on page 3 of your handout, under your cash from operating activities, write cash receipts from customers. Unless you've got the handouts, obviously if you've printed out the homework, all right, then use that. Otherwise, just write it in, because you're not going to get any of this in the exam. You have to write everything out yourself. All right, first line, under your operating, write cash receipts from customers. How do we work out that 424,000? We have to recreate our accounts receivable. Accounts receivable is an asset account. Asset accounts have an opening balance on the debit side and a closing balance on the credit side. Where do you get them from? You go to your balance sheet. You look at the second item there, accounts receivable, opening balance, 37,500. All right, tick it off as you're going along. All right, closing balance, 33,500. All right, the next thing we have to do is where do we get our sales from? So we go to our profit and loss. Our profit and loss, we can see we've got sales there. First item there in your P&L, 420,000. Tick it off, pop it into our accounts receivable. Which is the bigger side? The debit side is the bigger side. Add it up, and we've got 457,500. It's a T account, it needs to balance. So the other side must equal 457,500 as well. Now we've already got 33,500 in there. The difference is 424,000. So that means that is the amount of cash we've received from customers. Okay, so today, those people who came to lecture would know if we had bad debts or discounts allowed, that changes that figure, and the account, we also have to recreate your allowance for doubtful debts. We'll do that next week. All right, so this one's a bit easier. Okay, so our cash receipts from customers there is 424,000. Right, if we were going to use the formula, keeping the formula simple, starting off from the item in your profit and loss, you always start with the item in your profit and loss. So we've got sales, add a decrease in your accounts receivable. So if you have a look at your balance sheet, your accounts receivable has gone down $4,000. So 420,000, add that decrease gives you 424. See how much quicker that is? Right, and it's easy if you can remember the formulas and if it's simple. But right, when you start adding in discounts and bad debts, right, it starts to get a little bit more complicated. All right, but if you know the formula, I'm not particularly good with formulas, but you might be. Right, because everybody's different with their learning style. I prefer to use the T accounts because visually I can see and I can visualise the money coming in and out. With the formulas, I get confused, even when I've got it in front of me, making sure where have I plussed or minus correctly, because we add a decrease in an asset, but we minus an increase. We do the opposite. All right. And when you're doing that for your all your different accrual accounts from your balance sheet, if you haven't got it all written down, then sometimes you forget. All right. So you add a decrease, but you would minus an increase. Do the opposite. Okay, so that's the first bit. Well, that was easy. Next bit, we have to look at our cash paid to suppliers and employees. Now, there's a few figures there that are going to make up our figure of 375,500. So we need to work that out. First thing we need to do is our cash paid to our suppliers. So our suppliers our inventory. Have I gone too fast? Do you need me to go back to accounts receivable, or you're right? Okay. So what you need to do now is you've got your second line of your cash flow. So we've just done cash receipts. Next line is your cash payments to suppliers and employees. Okay, so the next T account is your inventory account. Inventory is an asset account, Opening balance is on the debit side of your T account, closing balance on the credit. They come straight from your balance sheet. Right, so just check it on your balance sheet. You've got an opening balance there of 66, closing balance of 82. Tick them off as you're going along. All right, we've got a cost of sales figure that we need to add in to our inventory. So this is inventory we've sold, so it's on the credit side there. Have a look at that in your P&L. You've got 281,000. We're going to add that in, which is the higher side. The credit side is the higher side, adds up to 363. We need to take that over this side of our T account to balance it out. Minus out the 66 that we've got in there gives us 297,000. Okay, that 297,000, we need to flow that through to our accounts payable. Accounts payable is a liability account. Opening balance from your balance sheet goes on the credit side of your T account. So we've got 22,000 there. Closing balance of 25,000 needs to go on the debit side. We've got our 297 that we've transferred from our inventory through to our accounts payable. This is the greater side. 297, add the 22 gives us 319. Take that over to the other side of our T account to balance it out. The amount of cash paid to suppliers must have been 294,000. So that's the first part of our calculation. Right, because we've got suppliers, employees and other. When you start to have discounts received, then that changes the figures. Make sure you're ticking everything off as you're going along. Okay, so the next figure we have to work out where those ones come from. The 79 and the 2,500. So we can have a look at our P&L and we've got other expenses there. We've got some insurance expenses and some other expenses that we need to have a look at. All right, so if we have a look at our balance sheet, we've got other accrued expenses. You'll see the opening balance, so they're a liability. The opening balance for liabilities goes on the credit side, 4,500. Your closing balance of 7,000. Pop in our other expenses straight from our profit and loss, 81,500. So tick that off. Right. This credit side is our biggest side, 81,500, add the 4,005 gives us 86, take that through to the debit side. Cash paid to employees must have been 79,000. So employees and other. We've got insurance now, so now we need to recreate our prepaid insurance. Prepaid insurance is an asset account. Opening balance on the debit side, closing balance on the credit side. We have an insurance expense from our profit and loss of 3,500. The credit side is the highest at 6,000. Take that total over here, minus out your balance of 3,500. Therefore, the amount of cash you've paid must have been 2,500. So 294, add the 79, add the 2,500 gives us the 375,500. Okay, so you can see what we are doing. We are recreating balance sheet accounts that relate to operating expenses. All right, because remember, we're doing our cash flow. We're doing the top part of our cash flow, which is our operating expenses. So we've got cash receipts, now we're doing cash payments. So we need to make sure that we review all of our balance sheet items and see if we need to recreate it to work out the cash component. We need to match them with our expenses, and there might be the odd expense All right, where there isn't necessarily an account in your balance sheet, so we can actually say that maybe there are some direct payments. Okay, if you were going to use the formula for your cash paid to suppliers and employees, you always start with your profit and loss account. So you've got cost of sales, add your other expenses, add your insurance expense, add the increase in inventory minus the increase in accounts payable, add your increase in other accrued expenses minus the decrease in prepaid insurance. So you can see it's not as easy now, is it, when you're adding in all those amounts, right? Because you start with your cost of sales and your other expenses, so those are your P&L items, but you've got your insurance, but you add your increase in inventory, but then remember, you minus a decrease in inventory. You minus your increase in accounts payable, but if it was a decrease, it would be add. All right, you do the opposite for each one. So once you start adding more and more items into it, it starts to get a little bit more complicated, doesn't it? All right, if there's one or two items, easy peasy. But when you start to look at all the different expenses, because remember, you start with your P&L items, so you could have quite a few other expenses. Here we've got them all grouped into other expenses, but you might have quite a few different ones that you need to add up together. And then you adjust for the movement. So you either plus or minus, depending on whether the balance sheet item has increased or decreased. All right. And if you like formulas and that's your thing, it might be perfectly fine. You might just, some people just click and it's fine. Me, I still prefer to do the T accounts because I'm more of a visual person. Also, if you've got errors at the end, sometimes I think it's easier to see the error in a T account than to see it sitting in a formula down here. But then for other people, it might be different. It might be easier for somebody else to see it in a formula. Remember, if your cash flow doesn't balance, you look for the difference. So if it's out $1,000, you look for that $1,000. If you can't find it, you double it or you halve it, and you look for that amount and you look for it. And maybe you've just got your opening and closing balance on the wrong side. All right, so this is why you have to be very structured and meticulous when you're preparing your reconstructed accounts. So when you've got a liability, opening balance is on the credit side, closing balance on the debit. When you've got prepaid insurance as an asset, opening balance on the debit, closing on the credit. And the only way that it becomes normal for you is doing it and practicing. Okay. So next we've got our interest paid. So we need to recreate our interest payable account because we're treating our interest as an operating item. So if we have a look at our interest payable account, we've got an opening balance there of $3,400, closing balance of $3,000, interest expense from the P&L of $11,500, add up the credit side, adds up to $14,900. Take that over to the debit side. The difference is $11,900, and that's your cash component for your interest payable. Right, little formula. Start off with your P&L item, interest expense, add the decrease in your interest payable. Okay, so there we have our cash flows from operating activities, cash receipts from customers, $424,000, cash paid to suppliers and other, $375,500. Your cash generated from operations, $48,500. Interest paid, that's another outflow, $11,900. Net cash from operating activities, $36,600. All right, so that's the top part of your cash flow statement. So now we just have to look at, so that's our operating, now we just have to do investing and financing. All right, so that's on your page 3, that top part. Remember, for the exam, there is consequential marking. So what that means is you need to make sure when you add up that it adds up properly. You don't just get to the end and say that it reconciles. If yours doesn't add up properly, you will lose marks. Whereas if you've done it, and even if your answer's wrong, you will get the marks as you're going through. You'll only lose the mark for the initial error. Right? You won't get marks as you additional marks if your adding up's not right. Okay, so next part, our cash flows from our investing activity. So proceeds from sale of land. Well, that was quite easy on page 2. It clearly said we're going to land with an original cost of 44 was sold for cash 34,800. All right, that's note A. Proceeds from sale of machinery. All right, very clear from note B that you got 34,000 cash. All right, your lease income received. We'll do that one first. We got 7,500. All right, we don't have if we had a lease income receivable account in the balance sheet, we'd have to recreate it to work out the cash component. But we haven't got one of those, so we can assume that that amount in the P&L of 7,500 straight away is our inflow from lease income received. Right, let's have a look at our land purchase there. So we need to recreate the land account and recognise the sale and highlight that there was actually more land purchased. The question didn't tell us about it, but if we recreate the account, we can see with the opening and closing balances that they must have purchased more land, right? So your land, your opening balance was 44,800. Your closing balance there is 40,000. We sold land with an original cost of 44,800. We sold it, so it needs to come out on the credit side. Therefore, when we balance out our account, add those together, 84,800, we must have purchased more land for 40,000. All right, so we have an outflow, so notice the brackets. All right, so it's a negative figure. Must have a purchase there of 40,000. So machinery as well. So machinery with the carrying amount was sold, even though it doesn't tell us that we bought any new stuff. If we recreate the account, they must have purchased some new machinery. All right. So machinery at cost, it's an asset. Opening balance of 300, closing balance of 360. The sale of machinery of 33,000. So we get that from the note. Okay, note B, it had an original land with an original cost of 33. So we're doing this at cost. Take out the 33,000, add up our credit side, adds up to 393. Take that through here, means that we must have purchased $93,000 more machinery as well. All right, so there was an outflow of 93,000. Right, and we only know that because we've been going through looking at the movements there in our balance sheet. So we know that we must have purchased some more. So one more to go. We've done the operating, we've done the investing, now we need to do the financing. And then I want you to have a go at 6.5, the first part of 6.5. We won't do the note. We'll do that next week. look at the next one. Let's have a look at the financing. So we've got a few items there under financing. Proceeds from issue of share capital. So if we have a look at our share capital, we've got an opening balance there of 100, closing balance of 170. So we must have issued some shares there. So proceeds from borrowings. So if we have a look at our long-term borrowings, the opening balance there was 120, closing balance 145. So you need to look on your balance sheet so you can see the movement. So if you look at your share capital, there's a change there of 70. You have a look at your long-term borrowings, there's a change there of 25. All right, so you've got to increase your bank loan and you've issued more shares, so you've got money coming in. 70,000 for shares, 25,000 for borrowings. Now with your dividends paid, all right, we need to, we can recreate our retained earnings, or we can have a look at our statement of equity. If you have a look at your statement of equity, it clearly says in there dividends paid 58,400. So you've got that on your hand. Dividends paid 58,400. All right, so that's our cash flow statement. Now let's put it all together. So look at your operating activities, adds up to 36,600. Your investing activities, there's an outflow there of 56,700. Whoops. Your financing activities, there's a net inflow there of 36,600. All right, therefore your there's a net increase in cash and cash equivalents there of 16,500. Cash and cash equivalents at the beginning. So if you go to your bank account, you had 6,500 in there at the beginning. Cash and cash equivalents at the end. We've got 23,000. All right, so there's our cash flow. Now this is a simple cash flow. All right, just so you know, this is a simple cash flow. It does start to get a bit more complicated. So if you don't understand how to get to the end at this point, you need to practice and or come and see me. All right, practice, practice, practice. So over the page, you've got a 6.5 or keep it limited. So the answer to this one's already on Blackboard, all right, the 6.2, it's there now, it's been up there all week. So this note disclosure here, that's up on Blackboard as well, but we'll come back to that next week. We won't get complicated. What we're doing here, our net cash from operating, 36,600 that we calculated earlier, we want to reconcile our profit of 27 to that, and how do we do that? We need to adjust for non-cash items, we need to adjust for non-operating items, and we need to adjust for movements and changes in our assets that relate to operating activities. All right, and that's how we get there. So if you want to have a look at that, you by all means do, and we'll have a look at it again next week. All right, so that's your P&L. That's your profit for the year of 27,000. That's our starting point. Our ending point is from our cash flow here. We want to reconcile to that 36,600. It's a requirement of AASB 107 that if you prepare your cash flow this way, which is the direct method, you must produce the note, and this is what the note looks like. If you use the indirect method, essentially this note replaces that section there, your cash flows from operating activities. But it looks a bit messy, doesn't it? Because it's quite long. So this is why this is quite long to have on the face of a statement. So you'll find that probably about 95% of businesses will use the direct method, which is this way, and then they'll have a separate note, which is that one in the note. So either way, you have to do both. It's just how you present it that differs. All right. So WSB 107 does have some specific requirements that you must show, things like interest and taxes and things like that separately, as do other general purpose financial reports. But it does allow you some flexibility with what you include under operating, investing and financing. All right. Okay, so question 6.5. So what I want you to do is to have a bit of a look at it and review, see how much of it you can do on your own. So it's now 6:50. We've really probably only got about 25 minutes to do it. Just let you have a go, about 20 minutes, see how far you can go, and then I can go through it. But you've got just a basic layout there. There's some spare pages on the back where you can do some recreation of your accounts. Those of you who've got your computers or you want to use a computer on your desk, you can jump online and have a look at the answer to the 6.2. But what I'll do is I'll just sort of put this one back to our cash flow statement that we've just done so that you've got that one in front of you. All right, so what you need to do is have a look at it, look at your balance sheet, look at your profit and loss, have a look at which ones you can work out and decide what's your operating, investing and financing. Some of it's easier than others, and so you might want to, you don't necessarily have to start at the top and go to the bottom. You can start with your investing or your financing activities, read the additional info, A, B, C and D there, and see if you can work out the different cash components. But number one, what are your cash and cash equivalents? So have a look. So we've got cash at bank, and that's it. So your primary cash figure you're reconciling to is 39,500. If you calculate your cash receipts from customers and your cash paid to suppliers, for example, you want me to check it as you're going along, just put your hand up and I'll come over. Right, so remember, cash receipts from customers, recreate accounts receivable. cash paid to suppliers and employees. You need to recreate your inventory and accounts payable firstly, and then you need to recreate any of your other balance sheet account relating to employee expenses and other expenses. Just thinking I might start going through it a bit quicker because there's quite a few items on here that there's a couple of items that are a little bit different that you might get stuck on, which was part of the point of the question, but we just don't have enough time. It took a bit longer. All right, so with Keep It, notice how on here that there's if we have a look at the additional information down the bottom, it says new demandable buildings were purchased for cash. Has anybody worked out how much yet? If you have a look at your buildings, there's a opening balance of $330 at cost and a closing of $430. So there's $100,000 difference. All right, so you look at your buildings, opening of $330, closing there of $340, so there's $100,000 difference. So we must have bought some. We haven't sold any during the year. During the quarter, a dividend to shareholders was declared. Is that paid? Is that money that's come out of your bank account? So the answer for that in particular is no, but we might have to recreate one of our accounts. A loan was raised during the year to provide cash for working capital needs. So we can see there's a loan there of $80,000. So we've got an inflow there of $80,000. Equipment that had cost $35 and depreciated by $20 was sold for $10. So we've got a loss there. All right, so there's a loss on sale, but we've sold it for $10. So a big circle around that 10, there's going to be a cash inflow. Is it going to be an operating, investing or financing activity? Yeah, it's an investing activity, so just write that next to it. So what's the bank account figure we're reconciling to? Number one, $39,500. So cast your eye over it. There's no other cash equivalents there. There's no bank overdraft or anything. So we're going to reconcile to that $39,500. So that's our end figure. All right, have a look at our income and expenses. Notice how we have got discount received, discount allowed, and bad debts. We haven't used them before. Discount received relates to accounts payable. Right, so you might want to write accounts payable next to that because we're going to include it when we recreate there. Our discount allowed relates to our accounts receivable. Bad debts relates to our accounts receivable and our allowance for doubtful debts. So do we have an allowance for doubtful debts at the moment? We haven't actually got one in there. All right, so we only need to recreate our trade debtors account. So just in case you've forgotten, trade debtors and accounts receivable are exactly the same. All right, so if there's anything lost in translation there with terminology, trade debtors is the same as accounts receivable. Trade creditors is the same as accounts payable. Okay, so let's have a look at our cash receipts from customers. So the figure we're going to reconcile to there is $436,000. So 400. Did anyone get that? That's why I thought I'd start going through it because I was having a bit of a look at what people were getting. You haven't taken into consideration the discounts and the bad debts. But let's go. Let's recreate our accounts receivable or trade debtors. It's an asset account. Opening balance of $77,000. So that comes straight from your balance sheet. So tick it off as we're going. Opening balance $77,000. Closing balance of $120,000. Discount allowed. All right, we need to put that $1,500 of discount allowed into our accounts receivable account. All right, so tick that off on your P&L as we're going through. Our bad debts expense as well, we need to tick that off and put that into our debtors account. All right, which side is the highest? After we put our sales into our trade debtors as well, so make sure you tick off that and pop your sales in there. Your sales plus your opening balance gives us 562. That 562 goes over onto our credit side. The difference is the 436. All right, that 436 can also be calculated by using the formula, starting with your P&L figure, so starting with your sales. All right, add your beginning accounts receivable minus your ending accounts receivable. All right, or adjusting for the increase. Add the discount allowed minus your bad debts. Gives us 436,000. Right, so that's our cash receipts from customers. Now we've got to do our cash paid to our suppliers and employees. So what we need to do is we need to reconcile to 413,000 outflow. Everyone okay with your debtors? Okay, so let's look at our cash paid to our suppliers and employees. First thing, we need to work out our adjustment for our trade creditors. So we need to look at our inventory. Our inventory account is an asset account, opening balance of 80,000, closing balance of 150. Pop in our cost of sales from the P&L of 365. That adds up to 515. That 515, we need to take that through over here. The difference between the 515 and the 18 is 435. That 435, we need to flow that through to our accounts payable. Right, our accounts payable, opening balance on the credit side of 60, closing balance of 120. We need to pop in our discount received on the debit side. Right, so remember when we did our trade debtors, our discount allowed was on the other side. Now we've got our creditors who we are paying. We have to add that back into our debit side. When we work out the difference between the 495 minus your opening balance minus the discount received, cash paid to your suppliers, 374,000. It's not quite 413 yet. All right, we've still got to do our salaries and payments to employees and other, which is 39,000. If we look at the formula, we've just got salaries and wages. We haven't got any other payables there. So if we have a look at our liabilities on our balance sheet, do we have any other asset or liability accounts relating to others? So do we have any prepaid expenses, accrued expenses, any other payables? We don't have any in there. Therefore, when we go through our balance sheet, our expenses of salaries and wages of 39,000 is the only ones. We must assume that that is a cash component because there are no payables attached to that. All right, so that 413 is made up of your cash paid to your suppliers, 374 plus the 39,000 payment to your employees for salaries adds up to 413. All right, so your cash receipts from customers 436 minus your cash paid to suppliers gives you a cash generated from operations of 23,000. Your rent received. Okay, if you have a look at your profit and loss, we've got rent revenue there of 14,000. Right, so we add that in. We've got income tax paid. We're going to have to recreate our current tax liability account to work out the income tax paid of 7,500. All right, so that'll be on the next slide. So if you have a look at our current tax liability, if you have a look at your balance sheet, you have an opening balance there of 7,500. Closing balance there of 17,000, income tax expense from your P&L of 17,000, meaning that the actual income tax paid is 7,500. All right, so we learnt a couple of new things there about accounting for your discounts allowed and discounts received and the bad debts. Also highlighting that you don't always have an account to reconcile. It might be a straight payment. All right, but you always look to your balance sheet. Do you have any other accrued expenses or payable type accounts that you might need to recreate? Look at the expense item, pop that in there to work out the cash component. If there is no balance sheet account, you can reasonably assume that the expense is a cash payment. Okay, so that's our operating. Now look at our investing. We've got our demountable buildings. We've already done that. You look at the opening and closing balance of your buildings was 100,000. So we paid for it. So it's an outflow. So notice the bracket. So that's a negative figure. Proceeds from sale of equipment. That's money coming in. If you have a look at that item there, it said during equipment was sold for cash of 10,000. All right, so if you just want to double check that 100,000, you can recreate the building account as I have here, or you just look at the balance sheet like we did earlier. Now, that's our investing activities. So the net investing activities there is 90,000. Now our financing activities, we've got proceeds from share issue. So if we have a look at our balance sheet, our opening balance was 400 and closing is 420. We must have received an additional 20,000 from share issues. Proceeds from borrowings, you can see we've got a loan due there, 80,000. It was nothing last year, 0 last year, 80,000 this year. So proceeds from borrowing, it's an inflow, money coming in, so it's a positive figure. Dividends paid of 20,000. So we're going to have to work out those dividends. All right, so we're going to have a look at our retained earnings account and we're going to have a look at our provision for our dividend. So if we have a look at our provision for our dividend, if you have a look at your balance sheet, there's a line item in there in your liabilities, a provision for dividend, had an opening balance of 20 and a closing balance of 30. That provision for dividend was the liability account. So we had opening balance of 20, closing balance of 30. Our dividend declared was 30,000. Pop that onto the credit side from our retained earnings in here. So remember your dividend declared, all right, of 30,000, that goes into your provision account for payment. All right, on opposite sides there. You don't necessarily have to do the retained earnings account. You can actually work it out just by doing the provision for dividend account. And there's a cash dividend paid there. It must have been 20,000. So you've got opening balance of 20, dividend declared of 30, gives you 50. Take that 50 to over here. Closing balance 30. You must have paid 20. All right, which is logical. Because remember, there's two types of dividends. There's an interim dividend and a final dividend. That provision for dividend there is probably the final dividend from last year. So that's the final dividend last year getting paid this year. So you could even reasonably assume, just by taking it straight off the balance sheet, that 20,000 was paid. Okay, quick double check by looking at your retained earnings and your provision account would validate that. All right, because you would never declare the dividend unless you had the cash and means to pay it. All right, you don't declare it and then pay it 2 years later or 3 years later. It gets declared, let's say your end of financial year is the 30th of June. It might be declared in, say, August, after you've worked out that you've made a profit, because remember, you can't make dividends, you can't pay dividends unless you've made a profit. So you declare it and get it all approved in August at your shareholders meeting, and then it might get paid in September. So in the next financial year, it would appear in your cash flow as the payment for your final dividend. Okay, so here we go. Here's your cash flow, all in together. So all your operating activities, so your cash receipts from customers, 436, cash paid to suppliers, 413, your cash generated from operations 23, add in your rent received, minus out your income tax paid, gives you net cash from operating 29.5. Your investing activities, you've got an outflow for your demountable buildings and inflow from selling equipment, so a net outflow there of 90. Your financing, we've got money from shares and borrowings of 100,000 and dividends paid of 20. Net result there of an $80,000 inflow. Add each one up, gives you a net increase in cash and cash equivalents of 19,500, and your add in your opening balance of 20 to give you the 39.5. So does it reconcile to your balance sheet? Yes, it does. All right, the next step, which we're not going to do now, the next step is to reconcile that 29,500 to your profit figure. So if you look at your profit and loss, you've got a profit there before tax of 45 and a profit after tax there of 28. So we can reconcile to both of those points. We can reconcile to the before tax and to the after tax figure. All right, we'll do that next week. But you have the note anyway in your solution, right? So I know. Do you have it? Did I give you the note? No, I didn't. We'll do that next week. All right. So make sure you bring this with you next week, and we'll just double check that note, and we can reconcile that note. Okay. So they were relatively simple ones. Okay, so it starts to get a little bit harder, but as you know, it's pretty straightforward. You've got items in your profit and loss, you've got items in your balance sheet. They are divided into operating, investing and financing activities, and we just have to work out what's the cash component of those. All right, so we will go through and we tick everything off. So we've only done part A at the moment by doing the cash flow, part B doing the note. By the time we finish the two, we've ticked everything off and we've looked at everything. All right, so you need to keep practicing. So your assignment is due soon. Not this week, next week. Is that right? Okay, so hopefully you've just about finished. If you haven't started yet, you're leaving it really late. All right, I need you to put in a decent effort with your submission, because I want you to have the skills that you need to be able to, you know, when you're going out there into the big wide world, that you're going to get paid money for doing a good job. All right, and that you can actually do a lot of these things independently. You'd be surprised that some of the simple things are what employers are really wanting and asking for. So being able to communicate effectively instead of writing a page, being able to write a paragraph. All right, so remember I've given you 2 pages for your executive summary, but you are allowed an appendix. All right, remember you are allowed an appendix, and if you think it's useful for your client who's paying you money that you need to put some additional information into an appendix, then do so. But you're still only allowed your clear 2 pages for your core submission. All right, in terms of what you say, when you do a little bit of an analysis, and then you have your recommendations and things like that. All right, make sure you look for the simple things. Make sure you've got proper headers and footers with page numbers, that you get names right, that you don't get the client's name wrong. All right, that's the one thing that you can't do out in the real world, and you'd be surprised at how many times people get the client name wrong. And maybe get it right, but spell it wrong. Or maybe spell Michelle with 1 L instead of 2, or forgetting to put an E on the end, or whatever. All right, so try to pay attention to some of the little things as well, but it's important that you become a good novice user of Xero, so that you can, when you're actually applying for jobs, because I can tell you now, I look every week and I look at the jobs and I look at what they're wanting, and they do want people to have experience with either Xero, MYOB or Reckon, It's surprising. I've seen quite a few reckon ones lately, but 0 is right up there with small business, right? As is MYOB. Right, so make sure that you practice it and you have a good look around and that you become a good novice user. Right, you don't have to be an expert. I don't mind if you cut a few little corners here and there as long as they're not important. All right, what you have to do is make sure that you put a good submission with your assignment, and this is for your client. So pretend I'm your client and I'm going to pay you. And if you hand me something that's not formatted properly, I might be looking at it thinking, well, I don't know if I really want to pay you. All right, so think about that because it's important. Okay, that's it. So if anyone's got any questions about this assignment, you can ask away now to 4.